wrote the book, but we were actually at 125 million. But I figured, 80 lessons on 80, wrote 80,000 to 80 million. Sounds like a good.
Sounds better. It sounds better.
It sounds
as a
better,
title.
exactly.
Yeah, for sure. In today's video, I had the opportunity to sit down with Thomas Beyer, who's a seasoned real estate investor and developer over in Western Canada with over $45 million in assets under management as of right now and over 30 years of experience in the industry. Thomas happens to also be the general partner who brought properties such as the Castleview Park Apartments and the Kimbrook Apartments to the crowdfunded real estate platform ADDY. Now, I rarely do interviews on the channel. In fact, last time I did this was last summer when I had Kevin O'Leary come onto the channel. Reason being is just because I like to limit these types of interviews to industry leaders that actually are able to share their experience and knowledge. And Thomas certainly is someone who has a lot of experience, over 30 years once again in the real estate industry, and that allows an individual or investor to ride through many different economic cycles, specifically also 2001 as well as, more importantly, 2008. Someone who's able to ride through these tough economic periods is someone that I want to hear from. So with that said, let's get to the interview. And to show appreciation for Thomas taking time out of his day to come on the channel and share his experience here, please take a second to drop an early like. It would really help the channel out. All right, hey, how's it going, everyone? It's Griffin here. Welcome back to the channel. Today we have the opportunity to sit down with Thomas Beyer, who's a real estate investor and developer out in Western Canada. Thomas, thanks a lot for coming on the channel.
Thanks, Griffin. Thanks for having me.
Yeah, sweet. So we're going to run through a couple questions here that I've written down. Let's first and foremost start with the fact that, I gave a short little introduction, but for most of my viewers probably aren't aware of who you are. Could you give us a bit more backstory about, I know you came to Canada let's hear a bit more about your backstory and how you got into real estate investing.
Well, when I came to Canada over 30 years ago, I couldn't spell the word real estate, let alone in English. Okay. So, I was working then as a software developer, and that was in the late 80s when Hong Kong was about to separate from England, from the UK, and go back to China, and there was a lot of money being moved out of Hong Kong into many states around the world, but primarily actually into the Vancouver region. And all of a sudden, prices started moving up, and that's when I heard the word real estate bubble the first time. Because I didn't know I was a renter then. I had a young family, but people said, "Oh, can you believe $250,000 bungalow in Burnaby, completely unsustainable? Who can afford it? Price to income ratio, bubble, bubble, bubble." I mean, the same words you heard the last 30 years, basically, but that's what I heard then. But interest rates were, of course, a lot higher. And we know today, of course, a $250,000 bungalow.
Interest rates back then were in like the 20% range, correct? It was before my
time.
But...
Yeah, in the mid-teens, and again, that bungalow today in Burnaby, which was a 150 and then went to 250 in about a year and a half. Today it's like 2 million, right? And that's when the real estate light went on, and then I ended up moving back to Germany for a few years. We came back to Toronto with my career at IBM, and then later to Calgary and Canmore, and then now I end up living in the Vancouver region on the Sunshine Coast, just north of Vancouver. But the real estate light went on with that discussion with my colleague in Vancouver and Burnaby at the time, and then realized, prices go up and maybe I should look into that. And we moved to Munich. I'd lived there before, and all of a sudden realized, well, there's all these buildings, well, someone owns all these buildings. And
yeah, exactly. Someone's paying rent as well.
Someone's paying rent. That had never even occurred to me. I was like 30 years old. That hadn't even occurred to me that someone actually owns buildings. And it could be, as we know, of course, it's government sometimes, it's organizations, but it's often private individuals or investment groups. And that's when I started to look into this whole space of investment properties. And I ended up buying my first property in Calgary, investment property. We had since bought a house in Toronto and then also in Calgary. But as an investment property, it was about 25 years ago, almost 30 years ago, in the 1990s. And that the first property was $80,000. And then I ended up going from there to, that was in Calgary, and then I bought one in Phoenix, and then one in Edmonton. I still own that. And then I ended up buying smaller apartment buildings while I was still working in my software career. And then I sort of semi-retired the software career and then started full-time investing in the early 2000s. Initially by myself and later with others.
Okay, so lots to unpack there. First and foremost, something that jumps out for me. So you said you started out with a couple condos, 2 in Canada, 1 down in the United States. I'm sure there were several years, I would assume, between buying those condos and starting to jump into larger commercial real estate, larger apartment buildings. What was really for you the shift between going from smaller residential to larger commercial? Because on my side, my business, I've looked into both. I invest in smaller duplexes, triplexes, and fourplexes. Haven't really jumped into larger buildings yet, and everything that has to do with the financing is completely different. What was the attraction for you, and what was really the switch for that?
Well, when I bought my first condo, was around $80,000 in Calgary. It was a 2-bedroom. And then I bought the one in Phoenix shortly thereafter, about a year later, and I realized, you know what, how much are whole buildings? Because if you and I buy a pound of flour, a pound of sugar, you and I pay a certain price. But if you and I say bakers, we buy a 100-pound sack, right? And the price per pound is quite a bit lower for that same sugar, for the same quality, maybe half, right? But I don't need 100 pounds. I need maybe 1 or 2 pounds. So I don't buy a 100-pound sack usually. And so I started looking into what is the price for, you know, an apartment building in, let's say, an average apartment building in Calgary or Edmonton. And I realized in Edmonton at the time then they were in the 30s per unit. So you could buy a 20-unit building for $600,000-$700,000. Calgary was a bit higher, maybe in the 40s, like $800,000 to $900,000 for 20 units. And the rents were similar, right? You bought a condo for 80 and the rent is, let's say, $700, or you buy that same building as a building and you pay $40,000 a unit, same rent. And I realized, you know what, it probably makes more sense to buy the whole building than just one condo.
So essentially, like the cost per door was significantly lower. Okay.
Correct. And then as you go up, of course, you buy 100 units, which I ended up buying a few years later. You pay slightly less per door, even then. It's more efficient, right? So you tend to get slightly better efficiencies the bigger you go, because a duplex per door is more expensive than a 4-plex, than an 8-plex, than a 20-plex, you know?
Yeah, depending on the area, for sure. And that actually, though, for a viewer watching this right now, most people who are probably watching our videos either have a couple small rentals and or none. Now, the difference, though, between jumping from, you know, getting financing for a small duplex or a triplex, typically they're looking at your personal finances, your credit score, and things such of that nature. When you're jumping into a larger building, though, can you just run us through some of the things that are taken into consideration? And for you, I'm assuming you also probably brought on investors and stuff. Were you able to do this with a smaller team, or like what was the scale of your team when you were jumping into larger buildings? Well,
unless you inherit a lot of money, and that of course happens sometimes, people have rich parents or rich grandparents and they'll leave you $1 million or sometimes even more when they die. Most people don't have a lot of money when they start, right? You usually start with your own money, and that comes from your savings, from your job, usually maybe from your spouse if you have one. And the big difference between multifamily and single family, or let's say duplex or triplex, is that the asset qualifies and not you personally, right? If I go buy a duplex, even if I rent it out, the bank wants to know how much money do I make, what's your personal income, you know, show me your T5s in the last, you know, 2-3 years. Versus I buy a 20-unit building or 100-unit building, or the biggest one I bought in Dallas was over 300 units. They look at the asset. What does the asset produce in terms of income? And that's called the gross rents minus vacancies, and then there's operating expenses, usually utilities and management and upgrades and insurance and upkeep and landscaping. They deduct all that, and that's called the net operating income, the NOI, and they want to see what they call a debt coverage ratio, a DCR, over the mortgage payment, usually somewhere between 1.1 to 1.5, depending on the asset class. So if you buy a large apartment building, let's say with CMHC mortgage, it's a 1.1 debt coverage ratio of NOI over the mortgage payment. If you buy a commercial property, maybe in a small town with 2 bays, you know, an industrial property, maybe it's a 1.5 debt coverage ratio. It's a more risky asset class, so you get less of a loan amount. But that's what the bank looks for. They're looking basically at the ratio of the income of the asset over the underlying payment required for the mortgage.
Yeah, so super interesting debt coverage ratio. All of these things are stuff that we have spoken about on the channel before. So hopefully,
Right.
I'll leave some descriptions for the viewers if so you can get more context about each one of these. But something I've noticed, at least in my market, so I'm in the national capital region, when I'm running numbers for debt coverage ratios and things of that nature for larger buildings, I found, especially over the past couple of years, as asset prices have really increased, the banks are often not willing to cover a large portion of the purchase price, right? Because there's a difference between like the economic value and the market value of the property.
Correct.
And often I've approached lenders and they'll be like, well, hey, we'll only give you a mortgage for 60%, but then 40% for someone who's starting out could represent $1 million or
Sure.
more, So
Correct.
what is something that could be done for someone in my position or someone else who's watching who might want to jump into a larger building but doesn't have all that money to invest?
Yeah, that sort of was primarily a function of the very low interest rates, right? Because low interest rates drove cap rates or capitalization rates down, which is the multiplier you use of over the NOI, and to the point where we have probably had too high prices now for many asset classes the last maybe 2 years, especially during COVID. And now we're seeing those prices come down to, I'd say, more realistic cap rates. And you see you look at REITs, for example, online, like Boardwalk or RioCan, a bunch of other REITs, their stock price have come off a bit the last, few months as interest rates have gone up in 2022. So I think today you might get what maybe used to be a 60% loan to value. It might still be the same mortgage, but the price has come off a bit. Maybe you need only 30% down. But I think this idea that you can buy an asset with 15 or 20% down, that's very, very difficult. That's how I started over 20 years ago. My rule then was, I'm not buying unless I can buy the building with only 15% down. And I could do that then. Today, that's not possible. You need to budget at least 25 to 30%. And I think that's, as a rule of thumb, again, sometimes you get lucky. So if you need 25 or 30% down, or maybe sometimes 35%, or in your case, maybe 40, the money comes from two sources or three sources. One is your own genes. It comes from other people's genes, i.e. people in your network, be it your grandmother or your mother or your roommate or your rich uncle, or people in your network, your golf buddy, the brother of the golf buddy, your church group, wherever you have networks, you can approach people in that space. Or it comes from the seller. The seller can also sometimes finance the purchase price by giving you a second mortgage. Or maybe you sell only a share of the building. Let's say you buy only 65% of the building, and then 35% will be acquired 2 years from now, 3 years from now, upon you doing some renovations and getting a higher value, higher rent rolls. So you can think, creatively out of the box. If the asset allows that, because many assets are tired and they need work and they need some upgrades that cost money, but then the value goes up, right? So you buy a building for 100,000 a unit today in Edmonton, perhaps, or 200,000 a unit in Toronto, but it might be worth 250 if you do a bunch of renovations, right? So you can talk about that. There's some sort of formulas for that, and then you do a refinance based on higher values down the road.
Absolutely. That's something I've implemented a lot myself, and something I speak about quite often also on the channel, because the reality is that in Canada, most people live in the GTA, Vancouver, a bit in Ottawa, Gatineau, and then Montreal, and especially Vancouver and then the GTA. So many people are having a hard time right now, especially people under 35 years old, getting into the space. We know, everyone knows, not everyone, but people who are interested in investing in personal finance know the power and value of investing in real estate and maybe want to, but it's taking a decade to save up, right? Because the value of assets has increased so much relative to income. And so for someone who is in one of those really expensive areas, I have my opinion about what people could do, but what would your advice be for someone who's in one of those positions?
Well, there's multiple points of advice. First of all, you got to choose your parents carefully, because they sometimes help you buy a house, which we did with our kids, right? One now lives on the island, in Vancouver and Island, and one lives in Edmonton. So we help them with some down payment, and many people do that because it might be actually a good investment for yourself, get the kids into a nice property. That's one option. The other option is you don't have to necessarily live right in Montreal downtown. Maybe you live in out of Montreal. A half-hour drive is a bit cheaper usually. But what we did is that we actually ended up moving to Alberta, right? Because Alberta always was cheaper, still today is cheaper, and the wages are actually higher, taxes are lower. So I think one can't assume just because I was born in Vancouver, I have now a right to live in Vancouver and Kitsilano in a choicest location 2 blocks from the beach. Yep. It's just so expensive. I don't have a right to do that. And yeah, I love to live there. Maybe I want to end up there, but maybe for the next 10 years, I got to move to Calgary and buy myself a house for $500,000 and live there and raise my family. And maybe once I get money in my 40s, and I move back to Kitts or Burnaby or Sunshine Coast or Gibsons or Surrey or wherever you like to live in that Vancouver area. So I think one needs to be realistic too and be flexible. I think many people, in my opinion, maybe speaking as an immigrant, are just, I shouldn't say too lazy, but too afraid perhaps sometimes to move. Mm-hmm. And it's kind of comfy, and grew up in Montreal, Montreal, but you've never been anywhere else. There's beautiful women
so
everywhere.
It's sacrifices.
There's lots of jobs everywhere. There's opportunity in almost any region in the world, be it Egypt or be it Indonesia or be it New York City, right? I mean, you just gotta sometimes get there and move there and see what the opportunity is. So certainly I think people need to sometimes look beyond their current sort of smallish, sometimes worldview they have, because they tend to live in one area for 20, 25, 30 years. But guess what? It's a big world out there. There's many, many opportunities. And that's why you see often many immigrants succeeding in Canada, because they made a big moves from the Philippines or from India, from China or from Europe to come to Canada, and they have a different attitude. They have this kind of, let's get going attitude and make it happen.
Absolutely. So that's it's interesting you mentioned that, because that was going to be my follow-up question. Right now, we're seeing massive levels of immigration coming into Canada. I think by 2030, there's supposed to be like over 500,000 immigrants a year coming into Canada.
Sure.
You came to Canada 30 years ago from what you said earlier. I think it would be Germany, correct?
Right. Correct.
Okay. So anyone who's coming in right now, I've actually noticed a lot of my viewers who are interested in personal finance investing and stuff actually do tend to be immigrants more than actual like born Canadians.
Sure.
Do you think right now the average individual is coming to the country has the same level of business opportunity and also just real estate investing opportunity as back in the day? Because right now, right, prices are a lot higher. But when you came, interest rates were at like 15-20%, right? And so every market's going to have its different pros and cons depending on the economic situation at hand. So yeah, I'll let you answer that one.
Well, I mean, because I lived in Alberta for many years, I think there's some parts of the world are by definition always more expensive. So if you want to live in Victoria, close to the ocean, or in Vancouver, close to the ocean, it will always be more expensive, right? Mm-hmm. You want to live in Toronto downtown, close to the beach there and up close to subway and shopping. It's going to always be more expensive than if you move up to, even Mississauga or further north or east or west. So I think one needs to be mindful that certain parts of Canada will always be expensive. And yes, prices came off a little bit in Vancouver, maybe 10% of 2021 numbers, certainly off the very high peak, which we had just earlier this year. But you compare price in Vancouver to last year, they are not off a lot, 5, maybe 10% most. And I think we've seen most of the correction already. We will not see a further drop, I think, because interest rates will probably hover around the 5% mark. So I think people need to be realistic that mortgages will be in the high 4s to mid 5s for the next few years. And you got to sort of roll with that. And I think Canada has certainly compared to, let's say, Europe, where I came from, more opportunity, right? We have oil and gas, we have huge agricultural opportunity, we have lots of land, there's lots of minerals. We have lithium, for example, for EV batteries, or uranium for nuclear. That's all the next emission-free energy sources being built the next few decades. So I think Canada has a lot of opportunity, but they might not be just next door to you in Montreal downtown, 2 blocks away. You gotta maybe move to Alberta, to Saskatchewan, or to maybe northern BC, or to rural Quebec, where they're building a new mine perhaps, and that's where the opportunity often is. It's not necessarily right where you live.
Yeah, and I speak about that all the time. I think that's spot on, where there's a difference also between where you're living and also where you're investing. When it comes to investments, like that, even more so than where you're living, I think expanding your horizons and your scope of geographic location of where you want to invest is definitely something to look into.
Sure, yeah, exactly.
Let's also speak though about the home itself, because most Canadians want to purchase a home. I think like 80%, or no, what's the stat? Anyways, home equity is one of the most powerful wealth building principle for Canadians. Absolutely, I agree as well. And the thing is, online, there's a lot of narratives that people are saying, owning a house is a liability. It's not a good asset to hold. You said that you purchased a house even, or helped at least with your children. I own my house and it's been a great investment because I bought it like completely undervalued and I was looking for something like that. Would you tend to agree with me that a home in a certain context can be an asset that's going to be beneficial for most people versus renting forever?
Yeah, absolutely. Because show me a wealthy renter, and I show you a unicorn. That exists.
Yes.
But so I talked about the condo I bought 25 years ago for 80,000, and I've since built a business and now sort of semi-retired. Sort of ramping it down and running a few assets and optimize them. So one of the lessons I learned, of many lessons in life, is that you ought to buy the biggest house you can afford. Now, of course, if you're younger, you can afford a lot less than if you maybe in your 30s or 40s or 50s, where you maybe have high income and made some money elsewhere. Maybe you can upgrade your house. But honestly, usually, unless I say house prices go up on average with at least inflation, like usually slightly above inflation because of cost constraints in urban areas. So if you assume inflation is 2 or 3%, or it used to be, you add another 2 or 3%. So house prices have gone up 3 or 4 to 5% on average. Sometimes more, sometimes they drop a bit.
Yeah.
So in this book I wrote here, which is called 80 Lessons Learned from 80,000 to 80 million, which was an asset base I was managing about 10 years ago. We were actually at 125 million. One of the lessons is buy the biggest house you can afford. Because if every house in the city you live in goes up 5%, the $1 million house goes up 50 grand and the house for 600,000 goes up 30 grand, right? So if you can afford a house for $1 million, then buy that one and not the one for 600. Because guess what? The house for $1 million is usually better in a nicer location, has more bedrooms and a fancier fireplace and a bigger garden than the one for 600. Now, on average, it's not always the case. Don't spend your money willy-nilly on crap, but on average, if you can afford a house for $1 million, then buy that and not one for 800 or 600.
So, all right. So I see what you're saying about buying a more expensive asset. And so if it goes up, let's say 5% on $1 million, 50 grand, makes total sense. I want to challenge you a bit on that though, because let's say someone who's going and fully maxing out their debt coverage, their personal debt coverage, wouldn't that allow them or block them from going and purchasing any other like rental property? And then they'd have to really like think outside of the box, where they not have to go and raise capital and find alternative financing.
Yeah, as I said, you should buy the biggest house you can afford. So that is a very personal decision, and that depends on your own income and your own outlook on life. And then maybe you're gonna have 2 or 3 kids, and maybe you're gonna get divorced. That also has all impact on your finances, right? So don't be stupid and risk everything on this one house, because that you might lose it because you spend way too much for it, and now we get divorced, and all of a sudden you have 3 kids and it costs money, and your wife stops working, and all of a sudden money is really tight, right? Don't do that. People should have some idea about their life, how it unfolds the next 3, 4, 5, 8 years, and that may include a spouse, it may include kids, and it may include investment properties. But ideally, the investment property should carry itself. So if you buy a property purely on appreciation and you have constantly negative cash flow, that's not usually a good investment. Yes, it might happen the first year, where maybe you have to do some upgrades, and maybe the rents aren't quite as high as they should be. There's maybe some negative cash flow the first year, maybe 2, but after that, it should carry itself. So therefore,
should be
you
stabilized.
need some money maybe to buy it, but the building or the house or the duplex or the 3 townhouses you buy ought to carry themselves, and otherwise they're not a good investment.
Yeah, that makes total sense. I'd like to, in parallel to the book that you just brought up, I'd like to ask you a couple questions about your portfolio over the years, if that's okay.
Right. Sure.
So it went up to, I think you said 80 million, right? Is
Yeah, 80 million.
assets
Well,
under management.
that's when I wrote the book, but we were actually at 125 million. But I figured, 80 lessons and 80,000 to 80 million sounds like a good.
Sounds better. It
Good,
sounds
it
better
sounds
as a
better.
title.
Exactly.
Yeah, for sure. Okay, so even better though, 125. So right now, reading through the prospectus on ADDY, which I think we'll talk about shortly,
Sure.
ADDY, it says right now, I think the portfolio is around 45 million, right, in assets under management. So based on that, obviously, as investors will do, you hold property for a certain amount of time, offload some, materialize some profits, for sure.
Correct.
Someone who's been in the game though for several decades, I've only been in the game for about 4.5 years at this point. And if I'm being real with myself, it was during a bull run for most of the time, right? Someone who has been through many different economic cycles, what are some ways that you've or some strategies you've implemented in your philosophy, your investments philosophy, as well as your portfolio to weather through all these different economic periods and not, go belly up and go bankrupt because you've over leveraged yourself or something like that?
Right. Well, I've many lessons there too, because you have to take a certain degree of risk, right? And I talk about risk taking in a book as well.
Mm-hmm.
If you don't step out of your house, you never experience outside weather, and if you never go to a foreign country, you don't know that they speak different languages and eat different food, but life is just good or better there as well, right? So you got to take some risk and go out and try something, and sometimes you fail, so failure should not discourage you, or the potential of failure to not do anything, right?
Mm-hmm.
Because you got to try something, and sometimes you fail, right? And maybe you got to learn from these lessons. So, for example, I did a development in Okanagan the last few years. I failed. I lost a lot of money.
Okay.
I had to sell my condo, really beautiful condo in Vancouver, and downsize here to the Sunshine Coast. Beautiful house, but it was a painful lesson. So because I realized that development is not for me. It's a different skill set than owning an asset which you just marginally enhance, right? Like the one in Calgary we're promoting with ADDY, or the ones I've done for 40 times, because I bought about 40 buildings over my career, and every building when you sell it is usually worth more, and it has been enhanced, sometimes substantially, sometimes moderately. So I think you got to make a plan of what are the interest rates going to be most likely over the next few years, what are the costs involved to buy this asset and also maintain it and or enhance it. And you can be a slum landlord. There's nothing per se wrong with that market strategy. You're going to get lower rent increases, but you also have lower expenses. That's an approach you can take. And the company I founded 20 years ago was called Prestigious Properties. I like to make them better, right? But that costs more money, right? So you have a suite, and I've a few hundred suites right now. You want to get the rents up 10%, 12%, 18%. You got to spend some money on it and get new sinks and new bathrooms and certainly paint jobs and maybe sometimes new exteriors. And you put that all into a big spreadsheet. So you have to have at least some basic math skills and some basic spreadsheet skills to say, look, here's what they're going to spend on this asset. So if I buy let's say 3 townhouses in Gatineau where you live, and I'm going to pay, I don't know, $300,000, whatever they cost these days, let's say $1 million for all 3. But I want to fix the, all 8 bathrooms and the landscaping and the fencing. Well, I got to spend maybe $80,000-$90,000 on that for the next few years. So I got to have that, not necessarily in the bank today, but at least in my budget so that I can do that. But then I get also more rent, right? And then maybe in 3 years I refinance the asset and then pull that money out. So that's the common thing. You put money in up front, you upgrade it, that's usually from cash, but then the value goes up and then you refinance and pull the money out and then recycle into the next asset.
Okay, so essentially, go for it.
So that's a common growth strategy that the initial capital you have goes into one asset. It will be improved, the rents go up, value goes up, then you refinance, you pull that initial capital out, sometimes more even, and then you use that money for the next building or the next asset class. And then and therefore you take initial $500,000, $1 million, and over time own 5, 6, 8 assets with the same money. But I mean, nothing happens overnight. You can't do it in 6 months and boom, boom, boom. It takes a while, right? You got to be more patient too sometimes.
Yeah, so that's really one of the things I think people who are starting to get interested in this. Online, everything happens quick. When it comes to real estate investing though, so you're saying for each building, probably having at least like a multi-year strategy for that
Absolutely.
building to, yeah, of course, that makes
I
total sense.
mean, real estate is a very heavy upfront acquisition, heavy cost, heavy entity. If you buy stocks online, they go online and TD Waterhouse, boom, 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 9.95 or even less. You can buy stocks in and out.
Zero.
Quickly, right?
Yeah.
Or Bitcoin, or you saw FTX, even cheaper. But the risk that you lose everything, as you saw here with the FTX collapse, is also very high. Versus real estate is fairly transaction heavy cost. There's inspection reports you have to pay, and broker fees and appraisal fees and legal fees, and then you maybe refinance in 2 or 3 years as refinance fees. So usually you want to hold for a long time, and long time means at least 5 years, and often maybe 10 years, to actually appreciate sort of the inflationary upside you get, and then also the value improvement upside you get. But that all takes time, right? And many provinces or states in the US have rent control laws.
Yeah.
So you have a tenant in for $1,200 a month. Well, maybe rent is now $1,500, but you can't push the rents up below $1,200 at maybe 2%, because the rent controller says that's it, 2% a year. So you get that $1,500, $1,600 market rent only on a vacant unit, right? So that's another big benefit in Alberta, for example. You can push rents up to any level quickly, much quicker.
You can?
Then you can,
okay,
versus let's say BC or Ontario, because there's no rent control. I mean, rent control exists, but which means you can raise rents once a year with 3 months notice.
Yeah.
There used to be, actually, when I bought in the beginning, you could raise rents twice a year, every 6 months. So we used to do that. They changed that.
I'm sure the tenants love
maybe
that.
6 or 7 years ago. Now you can do it only once a year, right? But at least you can do it. So let's say the tenant pays $900, but the market now is $1,000. Well, you push it to $1,000. Get $100. That's 11%, right? In BC, you would get $18, which is 2%, right? So that's one reason why in BC and Ontario, vacant units are so much more expensive now, because of the vacancy rent control laws.
Let's speak about ADDY a little bit, because now you're working with ADDY, which is a company. It's kind of like crowdfunded real estate that I've spoken about on the channel. So if you haven't, by the way, seen the video, go out and check out. I'll leave like a thumbnail right here. You can go check out that video. Essentially, there's pieces of commercial real estate, not pieces, but full-on buildings that people like Thomas will purchase. They're going to do, well, there's different strategies, but in this case, for example, upgrading the units, sort of like the BRRRR strategy, right, that we speak about. And what I do as well, adding units or facelifting them, increasing rents, increasing the value. What's the benefit for you as the GP to work with someone like ADDY versus just going out and working with a private lender who might just be, one entity or whatnot? I would think that would probably be simpler potentially. And also you're with 30 years of experience, I'm sure you have many contacts. So yeah, what was really the appeal to work with ADDY?
Yeah, I like ADDY. I like the idea that you can invest small amounts of capital. I've been doing my own fundraising for a good decade, and at the peak, I think we raised a total about $40 million over the last 15 years, let's say, from 2005 to maybe 2015. But I have 2 full-time people raising money, like dialing for dollars and talking to people, and a full-time acquisition guy and 2 assistants. So it's a 5-6 person endeavor, right, to raise money at that scale, because you're talking to hundreds of people. And there's maybe a 10-to-1 ratio. So you talk to 10 people and 1 person will invest in the end. And some people come back in a year or 2 and say, oh, what about that building in Dallas? I thought, well, that was sold out now. We did that 3 years ago, because I met this guy at some trade show perhaps, and we talked about the Dallas building then. And then finally, 3 years later, I say, yeah, you would have made 30-40%. And then okay, now they come with the check 3-4 years later. So that happens. But it's because of the security legislation in Canada. There's a lot of paperwork involved to raise money, and it takes an exempt market dealer who has to vet the investor and the investment, and there's a lot of forms to fill out, and that's very paper intensive, and we used to do all that, and I realized, I'm sick and tired of this. And I really love the ADDY model, where everything is essentially automated, and they use technology to systemize the whole fundraising process, including tax filings, for example, because once you invest money, you got to send you an annual statement, and they got to send you, tax return statements, T5013s in an LP or T5s in a corporation. It's just very paper intensive, and you need people to do that, and cost money, right? But all eats into the return in the end, because guess what? Who's paying for all this? Well, the investor pays in the end, because it's all an expense to the business.
Absolutely.
So if we can reduce these expenses, so now I'm running the company by myself with one assistant in Canmore. So it's 1.5 people, and we're running 45 million in assets. It's a very lean business. I just don't have the staffing to raise $10 million and be on the phone, the next year and a half to do that. That's not what I want to do. So ADDY helps you really systemize and streamline the investment process, especially for smaller investors, where there's the same paperwork, whether they invest $500 or $50,000. The same piece of paper you have to fill out, right, and file the security commission. So it's a very elegant way for me to raise a few $100,000 to maybe $1 million. And in this case specifically, the Calgary building is owned by 2 LPs, which have been running for almost a decade. And some investors want to get out. So instead of me selling the whole building, which of course I could do, and exit them all out, I just sell a portion of the building through this channel like ADDY, and then some investors will exit, maybe a dozen or so, or 15. And the other 125 investors will continue until we probably exit the building in 3.5 years, or maybe refinance it then at that point, to be seen what the market looks like. So it's an elegant way for the existing investors, for those who want to get out, to get liquidity, because one of the issues with real estate is it's not very liquid, right? It's
not at all.
It's pros and cons like anything. If you own stocks or REITs, it's very liquid. You go online, click, boom, it's sold. But it also you get the huge volatility, right, in the market. You saw something said Trump said something, or interest rates go up, or there's a war in Ukraine or COVID, boom, market goes up and down. And it's very volatile, because everyone on their cell phone can buy and sell stocks. In real estate, it takes multiple months to sell something. Sometimes takes a year to sell a larger asset. So you can't just, click and flip like you could in stock. So it makes it for a bit more smooth ownership experience, right?
Yeah, above everything else that you just said, that was one of the main things that made me fall in love with real estate as an asset class, because I've been investing in stocks and also crypto for years, like almost a decade at this point. But one thing that when I started purchasing property that I loved was the fact that, of course, I control the asset, I know where it is, I know the rents, I know how to optimize it in order I can estimate. And I've held stocks, for example, Facebook stock, where it's going great. They have amazing projections. One news article comes out, it drops 30%. And I'm just like, what the hell is that? Honestly, like, how can you predict that? As an investor? So yeah, that was really one of the reasons why, for me, a couple years ago, it switched. Or I've really focused on real estate investing and scaling that portfolio.
I'm also maybe more impatient man. I find it somewhat counterintuitive to actually own real estate, because I like to move really quickly and buy in fast and go in and out. Sure. But I'm also now aware, being a bit older, that's very, very, very risky, right? So obviously I have a large stock portfolio as well, but
well, you would have to for diversification, but I'm just saying
but most of the money I made over the last 30 years, I'd say, is probably 90% is in real estate, because not just the own home we live in, but also the investment properties, where the GP takes a stake usually and a smallish management fee. But because you have cash flow from the assets, much of that gets reinvested in the building. So that's one. So I call it a 3-course meal, right? There's the appetizer, which is the cash flow. But the main course is you pay your mortgage down every month, right? I mean, I know down to the penny 5 years from now what my mortgage will be in the Calgary building, for example. It's going to be paid down, by about $1 million in 3.5 years. So it's about $25,000 a month just mortgage pay down. There's a schedule that's very predictable. I don't know, of course, what the value will be in 3.5 years. There's some assumptions, obviously, you make about the world, but I don't know what exactly the value will be. but I know exactly the mortgage will be paid down. That's really the main course of real estate. And you hold long enough, even an asset which is completely flat, you're going to make money because you pay your mortgage to zero eventually. And of course, the appetizer of real estate is that you get usually the equity upside. Not always, and sometimes has cycles. If you see the last year or so, prices have come off a bit. But
I think that would be the dessert, would it not be? I watched a couple of your other videos.
The dessert. Sorry, yes, and the appetizer is the cash flow. The main course is the mortgage pay down, and the dessert is the equity upside. Plus, you get tax benefit on top of that. That any gain is actually 50% is not taxable, and the rest is taxable income. So it's tax deferred and tax preferred.
Exactly.
It's actually better than RSP, because if you, let's say, your Facebook stock, it goes from $100 to 500, you sell it, and you made a huge capital gain, and now you take it out from the RSP, it's actually all income.
You're taxed at the personal rate. Yeah, exactly.
Versus if you held that personally, or if you own real estate and it goes up from $1 million to $2 million over the next 20 years, that $1 million, the first $500,000 is tax free, and the other $500,000 you pay as income at that time. So it's a great net worth enhancer. Not necessarily a great cash flow provider, because cash flow is usually really tight, especially if you leave it 65, 70, 75%, there's really no cash flow to distribute.
Yeah, or more even. A lot of investors now are even more leveraged.
It's a great net worth enhancer, right? So that you still, and that's what I realized. I had my job full time until probably 20 years ago. That was great income. But to build my net worth, and that's what I use real estate for. So you gotta, and I talk about in the book as well about cash and cash flow. Because it's really important that you actually have a realistic expectation about the cash flow coming from a specific asset, which is often very small. Although you get wealthier, and your townhouse you bought for 300, now it's worth 400, you made $100,000, but it's not there. You can't spend it. You go into Safeway, because often they ask me at Safeway, do you want to pay cash or credit card? I often ask, do you take equity?
Yeah, hey, do you take equity? Well, they would take the money from your line of credit, your home equity line of credit. But anyways, that's
correct.
A different story.
So and that's what I do. So as your portfolio goes up in value, you usually then refinance or use the LLC to use money for the next building.
Yeah, so once rates, the property goes up in value, rates potentially go down, you can refinance, take some of that money, and just continue exponentially scaling, right?
Yeah, but again, talking risk, you got to be prudent, right? And there's people now who will get foreclosed on because they levered up too much, maybe bought in the boom, paid too much perhaps, got maybe too much of a leverage, and now the interest rates are higher, they have to refinance, all of a sudden they're hooped. So you got to be mindful of that you got to have some reserves, right?
Absolutely. Well, hey, thanks a lot for taking the time, Thomas, to speak with us today. I'm sure the audience is going to really enjoy it. If people want to learn more about you, where can they find you? I think you have a book as well. Speak about that a little bit so people can learn more about you. Yeah, so I mean, on the ADDY website, I'm doing a deal with ADDY right now. There's a bit about myself and the ADDY deal, which I think is a great deal, with probably a 40% return target in 40 months. So about 1% a month, which is pretty good in the current environment. I tried to dump all my knowledge here the last few years into this book called 80 Lessons Learned on the Road from 80,000 to 80 million. That's on Amazon or Kindle. Get a physical book or electronic book. And I got a website, Procedures Properties. There's a bit stuff on there. And you can always email me. I chit-chat, I blog frequently on various blogs, and pontificate on my opinion at the world at large, and always happy to help, especially people like your age, younger people who are 20, 30 years my junior, people, to help them get going. I love to do that. That's one of my passions. So happy to help. That's awesome. Thanks a lot for answering today's questions. And thanks a lot for coming on. See you, everyone.
Thanks.
Bye.
Thanks, Griffin.
All right, that wraps up today's interview with Thomas Beyer. Really hope you enjoyed it. If you did, please make sure to drop a like and comment down below any questions that you might have. I'll try to answer them as best as I can, and if there's any questions for him specifically, I'll reach out and try to get answers for you. Once again, hope you enjoyed the video. If you want to learn more about real estate investing, check out the links as well down below in the description to my real estate investing playlist with many videos already available for free on YouTube about how you can learn to invest in real estate yourself. If you want to take it one step further, check out my Udemy course. Once again, a link below down in the description. So with that said, thanks a lot for watching today's video, and I'll see you in the next one.